Our next guest says growth is likely to be modest this year. He's Michael Dix, Head of Economic Research at Barclays Wealth. Michael, good morning. Thanks for joining us. Yes, no jobs might be lost last month in the US, but still unemployment remains elevated. What's going to be the impact on wage growth, and how will that restrain household consumption going forward?
Well, I guess economists since the 50s have talked about a so-called Phillips curve, which means that when there's lots of people out of work or worried about losing their jobs, generally speaking, they accept lower pay deals than they would otherwise do. That relationship, I think, is the thing that's going to, with 10% plus unemployed, going to keep downward pressure on wages in real terms. And I think it's important to point out that, remember, inflation is coming back into the system, having been in negative territory. So wages are not going to keep up. They're going to move perhaps very, very slightly higher in the second half of the year. And that means that in real terms, the amount of money people have to spend is going to unfortunately rise rather slowly over the course of 2010 and probably into 2011 as well.
You say fiscal and monetary policy stances are inconsistent with medium-term stability. So how will they realign? When will they be calibrated to more sustainable growth?
Well, I think at the moment, the sort of running out of the cash for clunkers and other fiscal efforts means that we get a little bit of fiscal tightening, in a sense, almost in a natural way, in the second half of the year. But no one is really saying what happens after that. If we go back to a situation where the economy grows a couple of percent per year in a natural sort of recovery, where does the fiscal deficit end up? And the answer is, unfortunately, a big number, maybe 5 or 6% of GDP. At some stage, and my guess is it's related to the political cycle as it is in any country, perhaps after the midterm elections, we're going to have Americans being told, here's the equivalent of the sort of VAT hikes that we're seeing here in the UK, 1 or 2 percentage points of GDP fiscal tightening per annum for 3-4 years. And that's the sort of thing that will then take the legs away from the recovery, and I think mean it's fairly mediocre by historical standards.
That's your US view. Globally, you say growth will be lower this year than many are hoping for. Why is that?
Well, some of it is the US story, given its scale. And I think some of it as well is here in Europe. I think, again, we're seeing the beginnings of a turnaround. We're not really seeing the consumer kicking in, and where he or she has, like the UK, we're about to, again, see that fiscal tightening take away the legs, if you like, from the recovery before you get any motor, any real momentum behind it. Japan, I think, is in a far worse state, and we'll see what the new finance minister wants to do, but my guess is their fiscal effort will be one of the things they'll have to do. They haven't done much monetary response, so it's an economy dependent on the rest of the world. So that only really leaves you emerging markets that have, in a sense, got healthy growth, strong growth, vibrant growth back again. Even there, with the likes of China, where it's taken a massive fiscal effort, we're seeing with their worries on credit growth and liquidity, if you like, potentially creating inflation, the beginnings of the tightening. So they're growing too fast, if you like, almost to expect it to move up another gear. They want to keep it at this sort of level. So unfortunately, it's not a bad world, it's just not a strong recovery, and a lot of people have got perhaps a little extrapolative and a little bit overly optimistic about the pace of pickup.
Michael, thanks for joining us today. Michael Dix, the Head of Economic Research at Barclays Wealth.